Thanks so much for tuning into this conversation. Usually don't do fund launch conversations, but it's the timing of this product from ICICI Prudential Life Insurance that makes us get the EVP and Head of Fixed Income at ICICI Prudential Life Insurance, Arun Srinivasan, join in today to talk about one, of course, the product that they're launching, which is ICICI Pru Constant Maturity Fund, but also the fact that it is being launched at the time that it is being launched. Arun, good having you. Thanks for joining in. And
thank you, Neeraj.
The pleasure is entirely ours, Arun. Can you first let's talk about what the product is, and then I would love to understand about why is it that you're choosing this time to do this?
Okay, great. So Neeraj, basically life insurance companies have always innovated when it comes to equity funds. It's more from a creation of capital. We are long-term players. You have to stay with me for 5 years to 10 years. As long as you can take a particular call and move out in a month or two. What we've realized based on feedback from our policy holders and distributors, is that while creation of wealth has happened, how do you preserve wealth? Especially for a person who's at the age of 40, 45, he has created his wealth through either equity markets or real estate or any other route. And now how do you preserve that wealth for the next 5 years, 10 years, 15 years and get a tax advantage too? So I think that's when we were contemplating something unique on the fixed income side. No life insurance company has ever done it. So, and frankly, we have been deliberating on this constant maturity fund for the last 6 months, but we were still unsure on the way the interest rate trajectory was going. And once we were very clear that we are at the peak of interest rates, that's why we came and launched this fund. So this is a very simple fund wherein I will be maintaining a moderation of average maturity of between 9 years to 11 years. Predominantly government securities, state development loans, and AAA rated corporates is what we will be investing in, and ensure that the customer, the policy holder, is able to preserve his capital for the next 5 years, 10 years, 15 years, for which he's going to remain with me. So that's the whole genesis of this fund. The timing, as you rightly mentioned, yes, it's a peak of interest rates. At least we are very, very clear that there's no more rate hikes in India, looking at the way inflation has printed. Your 10-year GSEC, obviously, yes, it has rallied by 30 basis points in the last month and a half too, but I would still say this is an accumulation stage, and it will give us multiple opportunities to jump in. And here I think we are at the prime time when it comes to locking in money at the highest yield possible.
Okay. I heard you say that obviously because of the nature of the products and the nature of the organization as well, that you want the really long-term investors to be. So one, what is it that investors should expect? What is the kind of time horizon that investors should have ideally? In the blue sky scenario, the longer the better, but ideally the bare minimum that you believe people should have in mind when they are going for a product like this, else maybe they can go elsewhere. Part two, and what's the kind of, based on your assessment, Arun, what's the kind of returns that an average investor could expect, assuming that it is held to maturity?
Okay. Great. Thanks, Neeraj, for this question. Firstly, life insurance is long-term, as I mentioned earlier. So whether he likes it or not, he has to be with me for the next 5 years or 10 years. The biggest advantage of being in a life insurance is, by the way, this constant maturity fund, it will be one of my, in addition to the other 17 funds which we have on the equity side and on the actively managed income space. So the idea is, this is a investor who comes in at the present interest rate scenario, makes his returns for say 3 years, 4 years, and then can look to switch to any of the other asset classes. He can move into equities, he can go into my short-term fund, he can go to my actively managed debt fund if he wants to. But the idea is he remains here for 5 years to 10 years, locks in that money. And we have realized this, this is a record which we have seen. We have been, again, one of the only few insurance companies having zero NPAs since inception for last 23 years. If somebody remains invested in a fund for an extended period of time, I think that's where he makes returns. When you try to get in and get out and take active, aggressive calls on either whether it's on duration or in equity markets, I think that's where people make the mistake. So when you talk about returns, what I would envisage, if he remains invested for the next, for say 5 years or 10 years, I think he can easily make closer to a higher single-digit type returns. But the idea is more of a preservation of capital. So he preserves his capital in an asset class which is going to be completely risk-free to a certain extent, wherein the fund manager takes active calls on the composition of the fund. It'll be 9 years to 11 years, as I mentioned. It'll be a combination of GSECs and corporate bonds and SDLs. The fund manager's role is to ensure that he plays on the alpha point. So if I chance the corporate bond spreads are more attractive, he jumps into corporate bonds. If he finds SDL spreads more attractive, he buys SDLs. And he keeps churning the portfolio to ensure that the more duration of the portfolio remains between 6 years and 7 years.
Got it. Now, tie the timing of the fund and the nature of the fund that is there versus maybe, if you can, that is, some of the other products which might be catering to the same kind of capital preservation long-term theme. That is part one of my question. Part two of my question is just the volatility, or maybe volatility is a bad term, but just the kind of fluidity that we see in the current debt markets. What's your view about what happens? Because I heard you speak up and your view is very unequivocal about the trajectory of the rates. What's the outlook that you can give us for maybe the rest of the year, rest of the calendar, that is?
Okay, so I'll take your first question. Why this fund and what's the advantage, basically? As I mentioned, he can move out of this fund into any of the other funds of us at any point of time he wants to. So, for example, suppose by chance you see a very aggressive rate cut and rates go down, say the benchmark rates from a 6.5 goes to 5%, he makes a very, very handsome return, say in the next year or 2 years. And at that point of time, equity market looks much more attractive. He can just switch off from this fund, go into the equity market with no tax implication. So that's the advantage. As long as the money remains with me for 5 years to 10 years.
And no penalties, exit loads, anything of that nature?
No, okay. Nothing. So you can move out. So that's as I mentioned, as long as the money remains with me for 5 years to 10 years in the house, as a house, it's perfectly okay.
As a house,
so,
okay, perfect.
So that's the biggest advantage. And the second question is with respect to the view. As I mentioned, I think we are at the peak. Quite confident on the fact that we are at the peak of interest rates. I think RBI did a phenomenal job of keeping rates at status quo against market consensus. I think the last inflation number clearly showed that we are on the right side. We will see one inflation print at 4. Mostly the May print should come at 4. If I look at a forward inflation prints, we will be below RBI consensus. So if I look at it from on a technical terms, if I look at the real interest rates which we are actually very, very attractive at 150 basis points. I'm not saying RBI needs to cut by 150 basis points, but clearly from a trajectory perspective, I think we are on a downward interest rate cycle. While I do not expect an interest rate cut by RBI before the end of this calendar year, but I think market will start pricing that in. I think we will have to wait to see what happens to the Fed, whether they are going to be as aggressive on their rate cuts, and we'll have to see what's the impact on growth on both global markets as well as in India. But at least on the inflation front, I think we are poised for a fall in rates very soon.
Okay. One final question before we let you go. What are the risks on the horizon? Or, I mean, of course, the unknown risks can't be factored in right now, but the risks on the horizon which may kind of negate the current theory that you and possibly the markets at large and all of us have on the interest rate trajectory or the kind of returns?
See, Neeraj, every fund manager faces this risk on his view. So obviously there is always a probability. I have a high probability that rates are coming down. But What are the factors which can influence? Clearly, there are geopolitical risks. We are facing geopolitical risks that could have a direct impact on oil prices. Oil prices could go back up to $100, $110 a barrel. This is just a scenario which directly has an impact on my on inflation. I could have a monsoon thanks to the El Nino effect. I could have a bad monsoon, which would again have an impact on food prices. All these factors combined together could actually might be delay the rate cut by RBI. I might not make him raise rates, but it could delay the rate cut from RBI's perspective. And again, from an insurance company perspective, that's good because I'm in an accumulation stage. So while I will accumulate in this fund, it helps me in my annuity plans, it helps me in my other long-term fixed income funds which I run. So there will be risks in any fund manager's life. So it's the way you play your risks and rewards at this point of time.
Okay, fair call. Arun, thanks so much. Interesting timing, if you will. Though I can completely understand if indeed the belief is that this is the peak of the cycle, which it very well could be, and still not a bad time despite the rally. Thank you so much for speaking to us today, and all the best with the fund.
Thank you, Neeraj. Thank you so much.
And viewers, like I said, we don't usually do a fund launch conversation. It was just interesting to see the timing that has happened and maybe give a slice from somebody who looks at the debt markets very closely about what the trajectory could be like over the course of the next few weeks or months, if you will, and hence this conversation became important. Thanks so much for tuning in today.